So we'll get started right about now. So I'm very, very happy to be able to introduce to you Patrick O'Shaughnessy. He is the Principal and Portfolio Manager at O'Shaughnessy Asset Management. He has also published a book called Millennial Money, How Young Investors Can Build a Fortune, published by Palgrave Macmillan, is that how you say it? Great, awesome. I got there. He's also a contributing author to the 4th edition of What Works on Wall Street. So without further ado, Patrick O'Shaughnessy.
Thank you. So thanks for joining me this afternoon. So what I'm going to talk about today is stock selection factors in the equity world. I think this is an important topic today because while this used to be a strategy which was very, very fertile ground, meaning if you had come across this strategy 20 or 30 years ago, it would have been probably one of the best ways to outperform the market. It has become very common ground, arguably over-farmed or over-mined ground for trying to earn alpha in the US and international equity markets. So I'm actually going to talk about the ways that the industry, I believe, has misused this idea of factor investing. So broadly speaking, buying stocks both long and short, or building long-short portfolios based on factors like valuation, momentum, quality, low volatility, being some of the most popular factors out there today, and why instead future potential alpha in this style of investing will look very different. It will look more concentrated, so smaller portfolios of stocks that exhibit a lot of different characteristics, and ideally stocks that have factors that have not yet been identified and commoditized away. So this used to be a really, really great way to put your money into a simple, value portfolio and stop worrying about it. And the question is that sustainable for the future? So we've spent the better part of 20 years or so running money, so about $5.5 billion today, on this idea of quantitative, very systematic investing strategies. And the idea is simple, that you find key characteristics or common DNA of stocks that have tended to outperform, and you just constantly rebalance towards portfolios of stocks that have those characteristics in any given market. Most of this is done at first using backtests. So you get big historical data sets, financial statements, price data on companies going back anywhere between 5 and 8 decades. You find the best stuff, you build portfolios around them. Having spent, with a couple of the other presenters here today, I'm sure, more time than I probably should have with this data through history, I can assure you that backtesting looks a lot like this funny cartoon, where you see great results at the top level, but once you start actually digging in to what's driving those results, oftentimes it's microcap stocks that you can't trade as an institutional investor, or there are data issues or huge sampling issues. There are so many problems with building a strategy around just a backtest. And unfortunately, that's become probably the most common way for big institutional asset managers to market new strategies, because it's very low cost for them. It's very easy to set up a rules-based system that does something with a portfolio manager at the head of it who can somehow manage portfolios of 10 or 15 or 20 or 30 different ETFs. So it's a very scalable business model to build an alternative to a simple market cap weighted index. But unfortunately, I think that because everyone knows about these things, the excess return that these strategies have earned in the past may be to some extent jeopardized in the future. I certainly don't think it will go away, and I'll describe why. But I'll walk you through kind of the evolution of this idea of factor investing and how we think you should instead use factors to combine into an overall portfolio. So first of all, this just to kind of level set with this recent trend or deterioration I'm talking about with factors. This is 5 very big, broad, widely accepted factors that you can get. This data's on Fama and French's website. Sort of the big 5, if you will, for investing strategies for factor investors. Momentum, operating profit, which is basically a measure of quality. Investment, which is kind of a counterintuitive one. You actually want to buy firms that have falling long-term asset bases, and you want to avoid firms that have the biggest ramp-ups in their asset bases. So, biggest growth in goodwill, a lot of growth in CapEx, et cetera. They tend to be very expensive. Size, small cap, a little bit has tended to outperform large cap. And value, book to price being the most common factor there. And what you're seeing here, these lines going all the way back, many, many decades, is the annualized rolling 10-year long-short spread between best and worst. So you can see for this kind of whole initial period, let's take book to price as the example, that's the purple line. You're earning this kind of incredible and very steady long-short spread by doing nothing more than being long the cheapest stocks, cheapest decile of stocks by price to book, and short the most expensive decile. Sort of an easy way to earn incredible long-short returns. And then you can see what happens, and I've kind of broken it out by interest rate regime. So rising secular, falling secular, and then this zero interest rate period. But more importantly, what you see is this massive deterioration of these long-short spreads. So pretty much all at once, these factors that were sort of the one market's version of a free lunch, if you could have somehow identified them many decades ago, have stopped working to a considerable degree versus their long-term history. And this should be very alarming, because when someone knows about something, when everyone is agreeing on one way of investing money, oftentimes this happens with stocks. Oftentimes they get very expensive, and any edge that you may have had is very quickly eroded in the overall market. So when you see this kind of erosion, you should take pause. You should wonder whether a strategy like this is going to perform in the future. Now, there are very specific reasons why some of these factors have failed. So I'm not a believer in the size factor. You can see here that it's certainly the least consistent, the blue line, most volatile selection factor historically. And we happen to be sitting at the tail end of a time right now, in 2016, where large cap since '09 has crushed small cap. So it's been a great time to be a S&P 500 or an indexed investor. But the rest of these are pretty solid factors, especially these ideas of value, momentum, and quality. I would define quality very differently than Fama and French and kind of the academic literature does, but those are really good, well-proven long-term ideas for investing. Buy cheap stuff that's not completely junk quality, not over-levered to the hills, and buy it when it's trending. So something can stay cheap for years and years, wait till it has a bit of an uptrend, just the beginning legs of a positive trend in the market, and buy it. That's been a really, really solid strategy. But they can suffer, and you can see this deterioration happen fast. So this is the average long-short spread, so 10% on average, really good in rising and falling rates, but more recently, very small. There's an amazing book that if you do anything from this talk, what you should do is go read this book. It's called The Misbehavior of Markets by a guy named, a fractal geometrist, a mathematician named Benoit Mandelbrot. It is the best book you will read about markets. And one of my favorite quotes is that the trend has vanished, killed by its discovery. That's what happens in markets all the time. When there's a big advantage, people become aware of it, they put a lot of money behind it, that bids up the valuations typically of that idea or factor, and then it doesn't work in the future. Mean reversion is a bitch, as they always say. Book to price, I think, is the most interesting example of a law that's called Goodhearts Law. So Goodhearts Law says that when a measure of something becomes a target, it ceases to be a good measure. So there's a lot of examples of this. Maybe the most tragic one in the US is that homeownership for decades and decades was a measure of happiness, a quality of life. It became a target that Congress and the financial world sought to achieve for everyone, and we know how that ended. My favorite examples were in colonial India and Vietnam. So in Vietnam, they had a huge rat infestation problem. And so the government said, we're going to offer a bounty on rats. If you deliver a rat's tail, meaning you've killed it, we'll give you $20. So what people did wasn't kill rats, they just chopped their tails off, turned in the bounty, and let the rats go back to breed so that their bounty pool would increase. Same thing happened in colonial India. It was with cobras. They said, bring us a cobra and we'll give you this bounty. Well, what people did was they started breeding cobras, cobra farms. So they would breed cobras, kill them, turn them in for the bounty, and then the bounty payers realized this was a terrible plan, said, okay, we're not paying any more bounties. The breeders released all their cobras and the population was bigger than when they started. So there's always these unintended consequences when a measure becomes a target, and arguably price to book, the price to book factor, which was originally held out by Fama and French in 1992 as the seminal value factor. It had a lot of great features at the time, and if you had looked at a menu of value factors in 1993, which I'm sure Fama and French did, you would have seen that since the early 60s, value factors had all provided a pretty similar amount of historical annualized excess return. So you could choose book, earnings, sales, EBITDA, whatever you wanted to choose. It was a pretty effective strategy no matter what. They chose price to book because it's got the lowest turnover. So you could build a portfolio around it, turn it over 10, 20% a year, lower trading costs, better tax efficiency, and so on. And here's what's happened to those same factors, so this again, excess returns, since Fama and French published their paper. So very similar clustering of returns prior to the paper, hundreds of billions of dollars, including a couple massive asset managers that I'm sure everyone in the room is familiar with, had built strategies, value strategies, based on this idea of price to book. And you can see that since that time, it's been by far the worst performing book factor or value factor. You hear all the time, as we do on my quarterly calls with clients, that value has been getting killed by growth. And the reason people say that is because of price to book. They talk about the Russell 1000 or 2000 growth versus value, where growth has won. But if you had used anything except for book for that same calculation over the last 10 years, which is this period people are talking about, that story goes away. If you had swapped sales in for book, for example, for the last 10 years, your returns would have been 100% cumulatively better. So it's always a concern when a strategy, when a factor, when an idea, when anything becomes too popular and becomes a common target for asset managers, because very often what you see coming out of that popularity is an erosion of an otherwise strong historical advantage. The problem with momentum, so that's value. The problem with momentum is that it can be absolutely excruciating to live through certain periods, certainly long, short, but even as a long-only momentum investor. These are inversions in momentum that all have a similar feature back to the 20s, so all these circled periods, and this is not an exaggeration, so the long-short spread was almost negative 500% in 1 year for momentum coming out of the Great Depression in 2009, and I run momentum portfolios, so I can assure you this was excruciating. Long-short momentum underperformed by about 200%. So what happens is the market goes down 40, 50%. Market realizes that the world's not going to end. The stocks that were priced like the world is going to end bounce off the bottom. Think Ford, Bank of America, Citi, et cetera in 2009. They're up 4, 5, 6, 700%. You're short those stocks. You're long the stuff that had protected into the decline, which were barely flat in 2009. So you have these unbelievable inversions in momentum. If you think back to that first slide that you saw momentum tailing off as an effective factor, that's entirely because of really like a 5-month period of time. Since then, momentum's actually held up very well. Arguably, it's been the best performing stock selection factor, but momentum can be exceptionally painful. And this is true of most of these factors in general. It takes huge discipline to profit from these things. I would argue that most of the profit from factor investing has gone to sponsors or fund managers who use these strategies because they're selling, raising assets in these strategies, charging fees, and doing very well for themselves. The investor returns, if you will, time-weighted versus dollar-weighted returns have been horrendous. So even with clients of ours, quite honestly, now we've worked hard to build a much longer-term capital base, clients that really understand what we're doing. But like any strategy, people pile into something after it's done really well, they pile out after it's done badly. That has been the big issue with factor investing, like any other style, has been that people have not been able to stick with it because you have to live through stuff like this. So I'm going to talk to you instead about a very different factor, because I think the goal of anyone that's trying to do systematic investing, especially in the equity markets, is trying to do something a little bit different. And ideally do something that is not scalable, that cannot be commoditized away, because there are not enough companies that meet the criteria of the type that I'll talk about. So value momentum, very popular investing strategies. One that we are well known for and kind of hang our hat on is this idea of capital allocation. So this is really getting in, I'm going to sound, maybe I'm at the wrong conference, not a quant conference, but a fundamental conference. It's going to sound like a fundamental analyst might look at a business. But we like it from the perspective of a quant, because when you think about capital allocation, there's a fairly limited menu of options. So we can test how companies mix these options, sourcing and spending capital. So how can you source capital? Well, you can get it through normal business operations. That's arguably the best kind, internal financing we call it. You can use debt, you can use equity, and you can use float. So maybe float's the best. It's interest-free financing, payables. Warren Buffett's famous for using float to fund Berkshire Hathaway. That's really it. On the spending side, you can spend on CapEx, R&D, you can acquire other businesses, pay down debt, pay dividends, repurchase shares. That's kind of the major menu. And the question we have asked ourselves is, what mix of those different options has worked out best for the shareholders of those businesses? So value's great, momentum's great, but what about how businesses allocate their capital? Because they're investors too, just like we are. This is some interesting, admittedly, very high-level results for some of these categories. These are annualized excess rates of return, good and bad, versus U.S. large stocks. So this isn't there's no small cap effect in here. This is big U.S. companies. Companies that dilute their existing stakeholders, issue a lot of equity, issue a lot of new debt, have underperformed between 2 and 4% per year. Companies that are the biggest, what we call empire builders, so biggest growth in their long-term asset bases, most capex, biggest aggressive expansion, often at the wrong time at the peak of cycles, and companies that are the most acquisitive, often again at the peak of business cycles, have actually underperformed. That one often surprises people the most, because you think, well, investment for the future, you need to spend often to grow, and if you want long-term growth, you need capex. CapEx isn't evil, but the extremes of CapEx growth do tend to be evil. So you want to avoid companies with the highest rates of investment in percentage terms, year-over-year growth. Then you get to finally some good excess returns, which is businesses that we would argue have more disciplined capital allocation, are returning cash by paying down debt, and they're spending a huge amount of money on share repurchases. This next slide always gets botched, so I'll skip it. The idea behind that slide was, and probably the most important factor in all of this capital allocation, is share buybacks, which you probably read about in the news. It's become a popular whipping boy of corporations buying back their shares, and most often painted in a negative light, that they should be reinvesting, that this is financial engineering, they're issuing debt to just buy back shares. It's almost always negative. What we find is that for the most part we agree, but there is a small sliver of stocks, and again, remember I said you want stuff that is not scalable. You could not, iShares could not launch an ETF that could accommodate much money in this kind of strategy. Stocks that are repurchasing a massive amount of their shares outstanding, net of any issuance, net of any goofiness with employee options or anything like that, that also trade at very cheap prices with decent quality, has been an incredibly powerful combination for stock selection historically. So companies that have a more disciplined capital allocation, that aren't overspending, and that are recognizing a current discount to their intrinsic value by repurchasing sometimes 10, 15% of their shares outstanding, that category, very overlooked, and has tended to do very, very well. This is a distribution of the relative price. This is kind of maybe too complicated for this, but I'll go through it anyway. It's the distribution historically of the relative price paid by different companies buying back their own shares at different levels of conviction. So let's say you're repurchasing $1 billion of your own stock. If you're Apple, arguably that's a very low level of conviction in your stock. It's 1/600th or whatever their market cap is today of their overall market cap. If you're Parker Hannifin or Northrop Grumman or a much smaller, say $10 billion stock, repurchasing $1 billion, arguably you're making a much bigger bet in your own share price, 1/10 of your total market cap in the example of the $10 billion stock. So we define conviction between 0 and 5% of shares, 5 and 10, and then 10 plus, 10 plus being very rare but exceptionally high conviction. This is the distribution of all large stocks, so it's flat. This is valuation, so it's anything plotting here would be the cheapest 5% of stocks in the current market, most expensive 5% of stocks right now. These two lines are the high conviction group, and this is the low conviction group. So the low conviction has almost no skewness here towards preferring to buy back stocks at cheap prices. They're just kind of doing it because most large stocks these days are doing it. There doesn't seem to be a valuation play. They do slightly avoid buying back expensive, but look at the skew or the preference for high conviction buyback firms to be repurchasing their shares at very cheap prices. This is exactly the kind of category of stocks that we're after, because what they're doing is saying, let's reduce share count by 5, 10, 15%, but do it while we're trading in the cheapest 5%. These are PEs of 6, 7, 8, price to sales of 0.3, 0.5, really cheap relative prices versus the overall market. And there has been a very big difference historically in the returns of these different kinds of businesses. So all large stocks over the last 30 years or so, 11% return. Net issuers, so companies that are diluting their shareholders, have underperformed by about 1%. The low conviction buyback firms have outperformed by about 1%. But the high conviction category has done much better, outperforming by about 5% per year annualized, again, versus large cap stocks. This is a hard market to beat. Arguably, if markets are efficient to any extent, the most efficient market in the world is probably the US large cap market. So an incredible degree of excess return for a pretty interesting factor that typically is not represented in a portfolio of someone that calls themselves a factor investor. This works exceptionally well with value. So a quick word on value investing, which is probably the most popular form of quantitative investing because it's been around the longest, and it has great philosophical roots with guys like Ben Graham and Warren Buffett. We think of value investing as putting yourself out there as the house in Vegas. The house in Vegas, to take blackjack as an example, has a 1, maybe 1.5% edge. What they do is they turn that very small edge into a massive cumulative edge over time through volume, right? So they know they're going to win over time because the odds are stacked in their favor. In the short run, they can get destroyed, right? So someone can go on a run, and we would use a growth stock as an analogy here, a Facebook or something like that. A stock or a gambler can go on an extreme run in the short time, but over the long term, the house is going to win. value investing looks very much like that. So actually only about 51, 52%, so just like blackjack, percent of value stocks as we define them have beaten the market historically. But if you let that, in shorter periods of time, if you let that compound over time, we've actually never seen 10 or 15-year periods where these kinds of stocks have underperformed the market as a group. So if you bought a big basket of them. This is the distribution of value and growth. So value is much more peaked. This line is zero. So anything to the right of here is outperformance. I mentioned that's about 52%, about 48%. Growth has the bad kind of distribution that you want to avoid, but a fatter tail on the right. So there's more examples of growth stocks doing exceptionally well. Arguably, this is what keeps people coming back to the casino tables in Vegas. It's the same thing that keeps people coming back to buying stocks like Facebook, like Tesla today. You know, pick your favorite example. Almost the first question we get on any call or talking to an advisor or anything like that that might use a strategy of ours is, well, won't this process systematically miss stocks like Facebook and Amazon and Google and so on? And the answer is, of course, yes, it will, but we don't care because we're not interested in individual outcomes. We're interested in putting probabilities on our side. So by definition, to do that, you have to acknowledge that you're going to miss some unbelievable returns on the right-hand side of this distribution, but you also know that you're stacking the odds in your favor. So value works really, really well. Interesting that when you look historically at the returns, in an earlier talk, Matt Faber was saying that one of the great things about value is not just that cheap stocks outperform, maybe even more so, it's that expensive stocks underperform by so much. So if you're willing to build a portfolio that's not just a tilt of the market, but is a true, often painful to buy and often painful to own, deep value portfolio, not only are you getting longer term returns over here, but you're avoiding the stocks that tend to fall in this category. Yeah, question?
Which valuation metric is that based on? Like price to book or price sales?
So it's a combination of four. It's sales, earnings, EBITDA, and free cash flow, just equally weighted.
And so for those factors, like a trailing 12-month price book or whatever,
yeah.
Share buybacks, is that a similar thing like the last 12 months of share buybacks? Or since companies announce their share buyback plans, do you look more at what they claim they're going for?
Yeah, so same look back period, 12 months. You can do it shorter, you can do 6 months. There are blackout periods for when firms can repurchase their shares, so you don't want to go to a month or something like that. You can go back further, 2 years, but 1 year really does work best because you want actual activity, so you definitely do not want to act on announcements. There's studies that show 26% of announced buybacks ever actually happen. So it used to be a signaling tool. SEC got a little harder on firms repurchasing shares, so now they have to disclose it monthly, and that 26%'s come up. But you don't want to do it on announcements, so it's a 12-month look back. So that's the distribution, and so I wrote a book called Millennial Money that focused on young investors, and maybe one of the issues is that new generations keep making these same mistakes over and over again. So what you're going to see on the next slide is the most owned stocks that have the youngest median owners and where they plot today along this continuum. So these are the stocks that young people own the most of and where they sit and kind of the relative excess returns that those categories have earned historically. Apple arguably is just because the float's so big, everyone owns some Apple. But all of these stocks are extremely popular and fantastic companies, but there is a huge and important distinction between a good company and a good investment, and price is definitely squarely on the wrong side of these kinds of stocks. And then as people get older, so these are the stocks that have the oldest median owners. It's about the most boring portfolio. I couldn't script a more boring portfolio than this. But much cheaper on average than stocks that young people tend to prefer. So maybe this is just a big generational wheel of torture that people don't realize till later in life. So maybe too soon to when they're going to be selling their stocks that they should own cheap stocks.
Just real quick, isn't that just a commentary on also just the way the market at the end of the day values assets? Because to me, I look at this and say, maybe go back to the basics of finance instead of the DCFs and whatever we put numbers on what a business should be worth,
yeah.
Right? On aggregate, it's correct. And that's all this is saying, because every time you're overpaying for some future returns, you don't get them, and every time you pay some fair value or lower median, you get the return you expect. So there is an element of you know.
I think that
Back to basics.
it's an overused quote, but it's right, which is that in the short term it's a voting machine, and in the long term it's a weighing machine. And the problem is that that weighing machine is very long term. So over a multi-decade period, yes, stock returns tend to follow basic fundamentals like earnings growth. But for long periods of time, they can have huge swings around earnings growth rates. And so for all of you who are probably here because you're interested in outperforming markets or in systematic trading strategies, I think things that take into account psychology, price, sort of current opinions that tend to overdo it at extremes is the far more interesting way of profiting from all of this. But maybe it's just laziness at the end of life. You just touch it less and it tends to get cheaper, more seasoned companies. So one interesting thing is that value, which again, using the Russells as a proxy, has underperformed, is actually starting to look a little bit interesting again. So one of the things that we look at is the spread between cheap and expensive stocks. So arguably, you want that spread to be wide, right? So the value strategy works when spreads are wide and they start to narrow, right? So valuation ratios converge. For a long time, in the last 3-4 years, they've been very, very low, not at historic lows, but low. And then in the most recent period, now a lot of this is energy and materials, but they have started to spike up pretty aggressively. So maybe good news for longer term value investors that we might finally starting to be able to take some opportunity, buy some cheap stocks again, and expect to outperform. Here's what happens when you combine these ideas. So high shareholder yield we like, cheap prices we like. If you buy high shareholder yield and cheap, good return, 13.7%, you do much worse if you buy high shareholder yield at expensive prices. So if it's a high dividend yield and a lot of buybacks, but it's otherwise really expensive, that's been a really bad sign historically. You want to avoid it. The way this all then rolls together into a strategy, and I'll close talking about how you actually build a portfolio, is these are the things that we look for. Cheapness, momentum, we talked a little bit about. Quality I won't go into, but it's a whole other kind of more fundamental oriented, looking at balance sheets, looking at accounting choices, kind of preferring high cash earnings, et cetera. And then this idea of shareholder yield. So we build portfolios around that. The difference is between us and most quants, and probably the biggest philosophical disconnect, is most quants, famous and otherwise, that you get in here would say that factor investing or quantitative investing is all about broad diversification and averages, that you want big, broad exposure to hundreds of stocks, long and short, so you're not taking any individual name bets. You get higher information ratios doing it this way. You can hedge out industry risk, all this other stuff. We actually disagree. We think that the future potential for these kinds of strategies is to be more active. So there's a concept called active share, which has become very popular in the equity world, which is basically a number 0 to 100 that measures how different you are from your benchmark. So let's say it's the S&P 500. An active share of 0 is an index fund. It means there's 100% overlap between you and the market. An active share of 90 means you are extremely unique. It means that there's only 10% overlap between your fund or hedge fund or whatever and the S&P 500. Now, the industry's trend has been towards lower active shares, something called closet indexing. So there's this huge problem in our world of principal agency risk. I'm a fund manager. I want to keep my clients and to keep charging fees to run a good business. If I have a more active portfolio, which opens up the kind of the cone of potential excess returns, good and bad, if I strike one of those bad years, the odds of my being fired go up very quickly, right? And this agency risk has created this trend towards closet indexing where people build portfolios that look more like the overall market. It probably means they're not worth the fees that they charge, but it also means they're less likely to get fired in any given year. Active share is not a predictor of future excess return, but it is a good predictor of potential future excess return. So what this is showing you is we ran an optimizer to say, okay, in any given year, and this is just the average of all those observations, at different levels of active share, so 10, 20, all the way up to 90, what is the maximum possible excess return that I could earn in any one year? So you see that there's always this upward sloping line. It varies, but the average is that as you get more active, your potential gets better and better. So if you're going to hire someone that's a 20, 30, 40, 50% active share manager, you should probably arguably pay less for that manager because their potential is less. Now this cuts both ways, right? So the same is true on the downside, that the more active, the more underperformance you can have versus the market. And this is actual performance of all mutual funds over several decades by their active share. So you can see that cone I was talking about, where if you've got if you're an index fund, you're obviously going to look just like the market. As you get more and more active, the chances of doing really good or really badly widen. And arguably, if you're going to pay for active management, which fewer and fewer people are doing, you want at least the potential of earning excess return in the portfolio. And then the question is, well, how do I get on the right side of this distribution curve? And we think the answer is factors that are a little bit more unique, different takes on quality and value, this idea of high conviction buybacks, et cetera. Find your own factors. That's the whole magic of all this research world that we've evolved into. But this cone is really important. And the net result is that we think you should go a different way than the industry has. So everyone knows Morningstar charts, which show you a little dot that's the average. Usually it's small, mid, large, and then it's value, core, growth. And it's a little dot that says, okay, here's where it plots on average. And then the circle is 75% of the fund's holdings. So smart beta, you've probably all heard that term. It's most of these factor investing strategies are termed smart beta. They have hundreds of holdings, a lot of overlap with the market, low active shares, but charge active fees, or at least more active fees. These are some smart beta options. So we've got the Russell 1000, that's just the market. Russell 1 Value, arguably the first smart beta strategy, a tilt towards value using price to book. And then a very popular one for research affiliates called the RAFI 1000, which is tilting again towards smaller and cheap stocks. You see, a little bit of a preference for what we want, which is down here: good shareholder yield, great value, quality, etc., but a very broad exposure to the overall market. We think you should build instead portfolios like this, much more clustered around stocks with the best overall characteristics. These could be as few as 50 holdings in the overall portfolio. It gives you a much tighter exposure to the things that have worked well historically. The downside, and probably why you don't see more of this, is that it's not a scalable strategy. So this cannot accommodate the kind of assets that the major sponsors of ETFs and even mutual funds want, right? So you want to launch something that has the potential to have $50 billion in it to be able to charge fees on. This is not that kind of strategy. Even in large cap, it can accommodate billions, but not tens and tens of billions. And in small cap, you're talking maybe $1 billion or $2 worth of assets in a strategy like this. And I'll close by showing you a sequence of plot points where this is where the industry's gone, and then I'll show you what we prefer. This is every stock in the S&P 500 where it plots on that continuum. So this would be best down here, at least in our way of looking at the world. And the size of the dot is the weight of that stock in the index. So there's the S&P 500. There's the Russell 1000 value. So you can see a little bit of a tilt start to happen. You see less in the upper right. So you had some bigger weights over there that the Russell 1000 value is avoiding, but still very broad exposure. There's fundamental index. So again, a little bit more of a tilt towards that bottom left. There's a very popular ETF these days called minimum volatility, so very low volatility stocks, which also happen to be as expensive as they've ever been in recorded history. And there's the approach that we would advocate, which is one that is, again, much more focused in the kind of narrow corner. You see some outliers, right? So you rebalance this thing infrequently, annually or less often. Usually the holding period's 1.5 years, 2 years, something like that. So for example, this is a stock called XL Group, an insurance company. Had great shareholder yield, was buying back a lot of shares. In May of last year, it issued a bunch of shares in a cash and stock deal to acquire another business. So 10 months ago, 11 months ago, that dot would have been like this down here, and it's drifted and gotten smaller because the rebalance process, the kind of quantitative systematic process, slowly reduces weight to names like that. So this is the approach that we think will work in the future. It may not work as well as these strategies have worked in the past because everyone knows about and has access to the data that we use. But we would argue that because of the pain that it sometimes takes to stick with a strategy like this, because it can be painful for 3, even 5 years sometimes of underperformance, and because it's not scalable for the asset management business, which is a really important part of what drives stock returns overall, that a strategy like this, especially for individual investors, but for smaller investors, is a far better way of using factors overall. This is the kind of portfolio you get. So this is a 55 stock portfolio. It's got a shareholder yield of 9.2%, so almost 4 times that 5 times that of the index at 2.1. You hear all this talk about buybacks, but the index's buyback yield is actually negative, so when you account for all the share issuance that goes on at the same time, or basically no buybacks happening, which is pretty interesting. Very cheap, right? 12 times earnings, 1 times sales, 6 times EBITDA, a little more on free cash flow, but huge discounts to the market. Again, if value works because people get too pessimistic, the lower the valuation ratio, the more pessimistic, the better your expected future returns. That is only achievable in a portfolio that looks very different, that is very active relative to the S&P 500. That is not the direction the fund industry has gone. So those kind of advantages have led to very interesting results. I won't even tell you what the names of these strategies are because I'm not trying to promote them, and I don't think most people could even access them. But these two strategies, this is a small cap and a large cap version of what we've been doing for 15 plus years, are the cumulative just cumulative returns overall since 2004, which is when the small one launched. So 240 to 263%. We show them next to, we call it smart beta, but this is just the Russell large and small style indexes. So the major story has been growth outperforming value. So those are growth, those are value. When you put it in the lens of what can be achieved through a much more differentiated portfolio, all of a sudden that whole story seems to go away. They look very clustered, like they're all delivering kind of different versions of the same thing. And I'll close with an example that I've been using recently because I just think it's the best way of illustrating this idea between whether or not a strategy is about actually earning alpha or whether it's about gathering assets for the sponsor of that strategy. So the Russell 1000 value, arguably one of the most popular value strategies out there, one ETF alone has $25 billion in it. The iShares one. Largest stock in the Russell 1000 value is ExxonMobil, which is a popular value stock. Look at a lot of large value managers, you'll see ExxonMobil in there trading at low multiples of earnings, which is kind of a garbage way of evaluating an energy stock to begin with. But still, biggest stock in the S&P 500. It's there because of its price to book, which is the methodology behind the Russell 1000 value. It's only in the 50th percentile of all stocks in the Russell 1000 value by price to book. So it is the weight of stocks is far more determined by their size, and the derivative of that is the assets which can be accommodated in strategies which charge management fees to invest in them, than is its price to book itself. So if you believe in factors, any exposure to the market cap factor dilutes your advantage. But that is where the world has gone because there's an industry that sits on top of this. So I would urge you, read that book by Mandelbrot, and if you're going to go into the equity world using factors, do it in a way that is agnostic to the market. Don't be a slave to the S&P 500. Use factors to build a more differentiated portfolio because I would argue that's the only way of having a sustainable edge into the future. Thank you.
You guys implemented this in a long short model as well to see what happens when you short the expensive ones and then go long.
Yeah, so yes, and we failed. and the reason is, so you look at something like this and you think, God, perfect long short tool, go long this stuff, short that stuff. Two problems. This stuff is exceptionally volatile.
It's out of sync, basically.
And often very, just from a logistics standpoint, operationally, very expensive or impossible to borrow. So when you're talking about shorts, paper or back tests when it comes to shorts is a dangerous game to play. Because when you go and actually try to implement short sides of these factors in the real world, they can beast you pretty quickly. That's been our experience. I think there are very good ways of doing this. It probably is in large cap, where you start with the universe of easy or cheap to borrow stocks, and you do a lot of matching. So I didn't talk about like portfolio construction. Do you take industry bets? How big of an industry bet are you willing to take? Are you willing to take oil bets? There's all sorts of risks that get baked into a portfolio. A long-short application of this idea, I think, needs to very smartly and wisely manage risk exposures. So you probably want to be neutral to industry. You probably want to be neutral to big risk variables. Because those things can, think about, energy as a good example. If you were just long short value last year, you got absolutely destroyed, right? Because you got it two ways. You were long, miners and energy and stuff like that, and you were short Facebook and Amazon and those kinds of businesses. David Einhorn, who's a guy I respect, as much as anyone out there, felt that pain. A lot of big famous guys felt that pain. If you're agnostic to industry and things like that, you can get it both ways. And that is not fun to live through. And often client money will not stay with you through the times like that. So we've tried it. Frankly, we failed. Not to say we won't succeed in the future, but there are big hurdles to doing it right. Yeah.
Hey, have you had any experience with soft factors? For example, we have had situations where clients have come to us and said that find out the number of parking lots which is being filled by at any Walmart store, and more is the parking lot, probably better is the stock.
Yeah.
So have you had any experience with soft factors and how they sort of help us create that extra alpha?
Yeah, so the question is experience with soft factors. So we think about this as like unstructured data or just really unique things that might be specific to an individual company, like how full is a parking lot at Walmart or something like that. So the answer is yes and no. We've dealt a lot with things like sentiment and news data, where you use keywords and machine learning type stuff to try to find interesting factors. We don't use any. So we've yet to find something that is, we think, worthy of adding to our process. I didn't say this, but one of the big important things with these strategies is not changing them too much, because the temptation is always to rotate into the hottest new thing. There's going to be, there has been and will continue to be an acceleration of the amount of papers being written on factors, and a new one comes out and it's better than the factor you bought a year ago, and say, well, screw this, I'm going to bail on that one and go into this one. That kind of rotation is really dangerous, because typically papers get written at the tail end of a mean reverting cycle, so the factor's been doing really, really well, and then something structural, people write papers about it, and something structural changes or tendencies change and it does really badly. So a really important caveat to all this is there's going to be stuff that comes out after you choose the strategy that's going to test better than what you've got, and you need to be very careful about making changes. So when I say that we haven't added it, we have a super high bar for adding something into our process, and nothing has yet met that bar. Yeah.
Is this something you published in a paper?
Bits of it, yeah. I think probably 75% of this is in various papers and posts and things like that.
So when you say it's hard to short on that one, so
Yeah.
can that be like new options to achieve that part?
We could. Our mandate is that we believe in focus, so we are all equities 100%, and have not delved into the option market. We're not a hedge fund, right? So it's not, we don't have it just a wide open mandate. We're hired very specifically to do one thing. So that is certainly an option and a way around it. And this is on all stocks, so there's small caps in here. And I don't know enough about
Options will be expensive.
They'll be
on
expensive, yeah.
hard to borrow stocks anyway, because they'll be
Right.
pricing in the liquidity.
Right.
Could you go further discuss the difference between the capital allocation factors? I mean, the variance of returns within each one, and what the return windows are, because an acquisition factor is process, integration, etc. There's
Yeah.
a lot of variations in it, and the buyback is more of a spot.
So the answer is way too long to give here. When I said that one kind of simple back test I showed was high level, I meant it. Every one of those factors has a lot of nuance, and each of these factors has different information horizons. So like momentum's horizon is very short, 3-6 months. Values is very long, 5, sometimes 10 years. And these different factors have different horizons, and that's part of the management process. So I'll stick around and we can talk a little bit more about it, but each one is nuanced. Yeah.
Capacity limited, how close are you to capacity here? And have you thought about trying to do this elsewhere on the planet? Still be well.
Yeah, we already do it everywhere that you could do it. International, I guess we don't do frontier markets, but we do it in emerging markets. We do it in international developed, U.S., Canada. We are, depends on the strategy, either at or near capacity or not at all. I mean, our large cap strategy still has, I don't want to sound like too much of a crusader here. We still have a lot of capacity because it's large cap. It's all relative though. It couldn't accommodate 30 billion, which most large cap strategies probably could. So we already do it everywhere.
You don't need to go to Nigeria.
Yeah. Well, someday.
So I think we're out of time for this session. If you guys have extra questions,
I'll stick around.
Please feel free to go up and ask.
Thanks, guys
Thank you.
and girls.
We're sending you a